Hey, this is Hutch with bankingtruths.com, and today we're going to discuss front loading a whole life policy, specifically with first year dump-ins, just big single premium dump-ins, whether you have cash on the sidelines sitting in high yield savings, the Fed just lowered rates, making them not as high yield savings accounts. Maybe you're getting an inheritance soon. Maybe you're unwinding some stocks or mutual funds to take some winnings off the table from these all-time market highs, fearing the potential turbulence coming up. Regardless, we have done an analysis like this before, and our thesis has not changed. However, we are updating the numbers using the most modern whole life products. And in fact, we just recently put out an update. If you want to see just normal whole life policies without the maximum, like just big first year dump-ins, you can go to bankingtruths.com/update to see the updated numbers. So let's get into how this first year dump-in thing works mechanically, and then go ahead and look at the numbers. So you've probably heard me say when it comes to overfunding life insurance that more in sooner is better, and that's absolutely true. However, most people don't realize that there is a point of diminishing returns, and this limitation actually comes from the IRS. They will turn your policy into a mech, and they will revoke your tax advantages. So just like they cap how much you can put into a Roth, $7,000 a year, whatever that year's limitation is, there is a limitation with life insurance, but it's not linear. They just want to make sure you have a comparable amount of reasonable death benefit to support giving you the Roth-like advantages inside your cash value. They want to make sure that ultimately this policy is benefiting widows and orphans. So if you do want to disproportionately add and stack these turbochargers onto your policy, you need to add more death benefit. And you can only do that one of two ways. One is you can increase the size of the base policy, the bulkier, heavier part of the engine. But remember, these paid up additions are like microcosms of the base policy itself. They can only enhance the existing base policy. So the quality of that base does matter. But adding more will definitely increase your obligation, your ongoing guaranteed cost of whole life. And so the other way is to add the titanium chassis, the lighter chassis that allows you to disproportionately stack more PUAs early on. So there's one carrier in particular that allows you to do a massive first year dump-in. And we were wondering, like, wait a second, do they have a special deal with the IRS? How do they do this? And we were able to look at the rider itself. It's called a single premium paid up additions rider. You can see in this rider, they allow you to pay one time a massive amount and then nothing further. But really, when we looked under the hood, all it is just a beefed up, bulkier term rider, which kind of defeats the purpose. But putting more in sooner is usually better to that point of diminishing return. So we went ahead and tested it to see, is it really better than just adding a normal amount of term rider, stacking PUAs, or doing this big first year dump in and having a ton of PUAs right away, getting that money working for you, only to have the efficiency kind of fall off because you can't continue to add that kind of fuel on an ongoing basis. So that's what we're going to look at in this video. So let's take a look at the numbers. Okay, so we're going to look at a few different examples of how we triangulate and find that point of diminishing returns and back it off a little bit to find the sweet spot. But remember, this is for a 47-year-old second best rating doing 150K right away. Your numbers are undoubtedly going to be different. So if at any time you want to see your own situation custom model for you, go to bankingtruths.com/schedule, and we are happy to help. So at any rate, let's start with the most minimalistic design, just 150K one time. And I realize a lot of you are thinking, you know what, I want to be done right after that. But in order for any whole life to be optimal, you need to pay premiums for at least 7 years. Now, I realize other people are saying you cannot pay premium. It's true. You can always cannibalize the policy itself, whether it's borrowing against it or sacrificing PUAs to stop paying premiums earlier than 7 years, but ideally you want to pay something for at least 7, even if it's the minimum. Now, if you remember, that has to do with those IRS rules and the 7-pay test. It's actually how we optimize a policy before violating their tax guidelines. So all these examples you're going to see are 7 pays. Instead of just paying the minimum premiums, I wanted to get to round numbers. So after a 150 dump in one time, I just show you paying 10K for the next 6 years. Now, we are going to show different equalized versions of Penn, but we're going to show the most minimalized cost version of Penn. And with that, we can only fit in 40K maximum in any given year. To equalize with the Lafayette, we're going to pay 40K 4 times. then 20, then 20, then 10, and they actually get equalized with the same amount of money as in the policy by year 6. And even though Lafayette had a lot more money going in sooner, Penn is already ahead by the time they're equalized. By the next year, year 7, they're pulling farther ahead. And after that, certainly because we are going to do what's called a RPU, or a reduced paid up, where we just strip both of these policies of all the charges, all the costs, and just turn them into growth machines. Well, you can see, even though Lafayette started with a lot more death benefit, you needed that in order to fit in 150. All that extra death benefit in the beginning was kind of a weight. It was kind of a drag versus the Penn. We were able to start with a smaller policy, the titanium term rider, and then once we go ahead and optimize it by stripping the cost, you can see it's just pulling leaps and bounds ahead of the Lafayette. So before we look at the Goldilocks sweet spot scenario for Penn, let's take it to the other extreme and make Penn a much bigger policy to get as close to the one pay, that $150,000 dump in with Lafayette. We're going to do a two pay, not like the wig. We're going to do two pays of 80, which equals 160. And then in order to equalize the Lafayette, we had to kick up the premium in years 2 through 7 from 10,000 to 18,000. Now, to be totally clear, we did not increase the size of the base policy with Lafayette. We didn't have to because they had that rider. In fact, we're actually paying the maximum this rider will allow you to pay in future years, which should help Lafayette because we've opened this big bucket and now we're filling it to the maximum allowable capacity. Well, with Penn, we're not. We actually had to increase the amount of base premium, which you would think it would hurt. We talked about that bulkier engine, but we also talked about that engine is really just a microcosm of the PUAs, and the fact that Penn has more efficient base policy, even though we're increasing it, it's actually not that bad. If we look by year 7, we can see that it's almost even with the Lafayette. That's when all the premiums are exactly equal. And really the Penn base is 18,000. So for those other years, 3, 4, 5, and 6, we're just paying slightly more in PUA. So we did these two big dump-ins, then we're min funding a pretty big base premium, and it's almost even by year 7. And after that, once we do an RPU, you can see Penn has not only more cash value, but more death benefit by a pretty wide margin. In fact, if you look closely, by year 25, Penn has almost as much cash value as Lafayette does death benefit. And if you remember, this is very important because with any base policy, the cash value has to equal the death benefit by life expectancy. So it's almost like pole vaulting. You want to raise that bar as high as possible because with the whole life policy, you have a pole vaulter that will always reach that bar. So if you've seen my recent whole life policy analysis where we compare all the major whole life players, you remember this heat map. And this heat map is just isolating base only. No term rider, no overfunding. It's actually for a 45-year-old. What we're looking at in this video is a 47-year-old. This is actually just 10 pay base only. We've been looking at a 7 pay, but it's really close enough for you to understand the concept of why, if Lafayette had such a head start and they actually had smaller base and more PUAs, why they would underperform long-term so much. And it has to do with the quality of ingredients, not only for the base policy, but remember the PUAs are really just microcosms of this base. All right, so let's look at that Goldilocks sweet spot size for Penn. We just looked at the 80K two pay, not the wig, but a really big policy, which actually wasn't that bad. As soon as we stripped it of all charges, Penn started beating it on a regular basis going forward. If we just split the difference and do 60K times 3 and then some smaller premiums, it's not a minimum premium because we brought down the size of the Penn base and therefore the term rider. You can see the total death benefit is about half of Lafayette's. You can see that when everything is equalized by year 6, they both have in the same amount of money, 240K, that Penn is winning by a noticeable amount. And then from that point forward, it just kicks butt. Now, if you remember when we looked at the two pay, the 80K two pay, the cash value was almost as much as the death benefit. It was 737 actually. Here we're at 756, plus we have 1.1 million of death benefit that the Penn cash value has to grow towards. So there's actually another big advantage to using pen if you plan to have multiple dump-in events over the course of your life. Maybe your real estate investing is going to go really well and you're going to need a place to put the spoils when you sell a property. Maybe you're going to have windfalls in the stock market. Maybe your side hustles are going to go well. Your income's almost certainly going to go up, but maybe you'll get some massive bonuses. Well, with the Lafayette policy, if you remember, you could put it in the 151 time. That's because it's called a single premium paid up additions rider. After that, you were limited in how much paid up additions you could put in, quite frankly, because of those IRS limits. So the most you could put in after that was $18,000, and that's only for until year 7. After that, you actually get squashed back to $16,000 and change. Not so with pen, because you didn't use up all that capacity. You can do a lot of 60s. So if we wanted to equalize this, call it maximum funded Lafayette, over 21 years, you can put in $487,000 with pen. You can get the 487 in by year 9. So same amount of money in. It's kind of not fair because now we're front loading in the pen. But if we look at what the performance is like at the end of year 25, pen is massively ahead. Now, another little fun fact, if we look at both of these long pay scenarios, is if we look at their guaranteed columns, not because I think it's going to happen. Both of these companies have paid a dividend every year for 100 and some years. Penn's actually the second oldest mutual company. They paid dividends every year since the Civil War. But I think it's good to consider the overall quality of the base policy, because remember, even if no dividends are paid, the cash value has to equal the death benefit. And if we look at the 21 years of premiums in the Lafayette policy, you put in 487, they have 466. That's pretty good. Almost all your money's there. You're light about 20K, not a huge deal. And again, they're going to pay dividends, so that's probably never going to happen in any universe. And you do have 684K of permanent death benefit. Now, if we look at 21 years of the long pay premiums into the pen, you notice you don't have 487, what you put in, or 466, you have 571. And actually, if dividends are paid, just going forward with this schedule, you actually have 960. But just going back to the guaranteed parameters, 571 and not 640 of death benefit, you got an extra 400K of death benefit, which you may not care about now. But remember, the cash value has to equal that death benefit. So again, the guaranteed values for me just show the underlying quality of a whole life carrier's base policy. So hopefully this video gets you to realize that how quickly you can get money into a policy is not the most important thing, contrary to what others are saying out there. We've been saying the same story for over a decade now, that quality matters. Performance is the most important metric, which is why we go to painstaking measures to constantly put out updates about the different policies that are out there. And if you want to see how we work with clients to customize for their situation, we have a video called bankingtruths.com/sizes, which shows you how we triangulate whether or not you have a dump-in to find that Goldilocks sweet spot size for you. And whenever you're ready to look at your own numbers, speak with one of our experts at bankingtruths.com/schedule, and we hope to talk to you soon.